Paul, let's kick off. Top line, the impact, if any, the virus had on the market so far. What are you seeing over the last couple of weeks? What's the overall sentiment of investors and buyers at the moment?
Yeah, look, I mean, I think the early prognosis is it's probably having an impact on potentially current investors and buyers who probably were considering something based on their current financial position, which includes their job security as well as their borrowing capacity. I think people are pivoting very, very quickly now, which is starting to assess, is it the right time for them personally to go now, or is it something that they might want to hold off for the next 2 or 3 weeks? I think if we're looking at the owner-occupier sector, we're probably too early in the piece to really see what's going to happen as far as a slowdown in listings, as well as a slowdown and dropping of auction clearance rates. And more so because I think because we're only really 1 to 2 weeks into this, probably the real change of what's happened from our economy as well as the way we're living our lives, and obviously only a couple of days into a holistic shutdown, we're probably going to see a transition over the next 2 or 3 weeks from people who have sold and were looking to buy and have to buy because they've already committed to selling or have already settled, so they need to actually find another home immediately. Once that buy and sell activity for owner-occupiers has passed, which I think personally we're probably going to be 1, 2, 3 weeks away from that, that's when we're going to see listing volumes drop off almost immediately. So we're going to see, I would expect somewhere between 25 and 50% dropping in volumes. And that's going to be the first thing that'll happen is we'll basically see the market tighten right up because people are going to see less opportunity to think that they will sell, and people are going to think less optimistically about what they want to buy and the assurity of their property or their income to buy property in the next 2, 3, 4, 5 months. So that's probably the immediate impact we're expecting across the board.
There's a question here, it's from Anonymous. It says, we are planning to buy our first investment property by September, but now unsure whether to continue. Our jobs are stable. What do you do?
My first questions are, is your job stable? Is your economic position as far as your borrowing capacity, your surplus and your buffers all in place? And if your intention is to invest around about that August, September, October timeframe, I couldn't think of a better scenario that someone could possibly be in right now than to stay true to that. If anything, I'd say be prepared to be a bit more maybe nimble with that timeframe in September, because you might actually see opportunities come a bit sooner, because by September, the new norm and what future looks like from an economic standpoint will probably be found out a lot quicker than that. So I would almost say that if you are in a position to move a little bit sooner, June, July, August, be prepared to go then. If your jobs are stable, your income, your borrowing capacity, your surplus and buffers are all in place, then I would say that is quite possibly the best position that anyone could be in right now.
So gearing up for that particular point in time, Paul, what tactics would you be employing right now to make sure you're ready to go when you're ready to buy?
The biggest things I would be considering is your borrowing capacity. If your jobs are stable, that's probably not going to change. So your borrowing capacity will stay somewhat the same as what it has been. The thing that has changed probably in the last 2 or 3, 4 weeks, if you're planning to buy in September, is that what you were doing your math on from a borrowing capacity or even an interest rate repayment, that is actually going to be probably sharper by the factor of 0.3 to 0.5% interest rates. And also we're now seeing that the next 3 to 5 years of 3-ish% interest rates for investors, probably 2.5 to 2.8% interest rates for owner-occupiers is almost a surety now. So the beauty and where the absolute probably rarity of this point in time for anyone who's trying to invest and do their math and set up correctly is the fact that a P&I repayment in a 4.5% gross rental yield residential asset right now is looking like it will be cash flow neutral. And that is something that people really need to understand, is that you're going to be in a position that's so unique in the fact that you can start paying off your debt immediately and ultimately have zero impact on your day-to-day cash flow, even if you're borrowing at 100% in most places. So I'm looking at properties which you have that ability to stay cash flow neutral to mitigate additional risks for at least the next 1, 2, 3 years, but then also look at areas which are going to rebound dramatically after we see the rebound or the turnaround from this position that we're in. So areas which have got a lot of essential services, areas which have got a lot of government employment, and areas which are going to benefit from broader economic booms, because the things that are going to have to be brought forward here are infrastructure spend that's state and federally based, and they're going to want to supercharge and inject those jobs immediately. So major metro is going to be the major recipient of all of these additional stimulus, which will come in the next few months. They're not the handouts, they're probably what we're going to be able to do to get people back to work. work. And we're going to see that these jobs that we've touted for the next 5, 7, 10 years, they're going to be all brought forward, and these major infrastructure projects, I would expect, are going to be supercharged to bring the economy back in those markets.
Now, there's another question here. It says, Paul, how will this affect the property market and its prices? How long will it take to recover? So this is making an assumption that prices will go down as a result of COVID-19. Is that going to happen?
Yeah, look, it's time will tell that scenario. And if the biggest thing we've been looking at probably over the last week or two is trying to reflect on what have been some similar impacts to the economy over the last 30 to 40 years during the same era that we're kind of in, and looking at everything from probably going from the dot-com crash all the way back to the Asian financial crisis that was back in the mid or early 2000s, going right back to the 87 crash as well, and probably what happened on the back of the crash from an economic standpoint, what happened to the property market at that same time, and what happened from a recovery perspective. And it's quite similar to what, if we look at what happened probably over the last 2.5, 3 years in probably Sydney, Melbourne, and if you look at more broadly the Australian property market, as we saw the Royal Commission into the banking sector come through, we saw tightening of credit, we saw basically Sydney market came off by 15 to 20%, depending on where you looked, and it took about 2 years to get to that bottom. And over the last 3, 4, 5, 6 downturns, which basically takes us back to the mid-80s, the time it took to get to the bottom is almost the equivalent time it took to get back to equal or equality or wherever it was before it came back down. So as much as we don't know where this is going to find the bottom of most markets, what we do know is that what history's shown is that by the time we've found the bottom, it's going to take almost that same amount of time to get back to the top. And I expect that we'll probably see 3 to 6 months of probably immediate pausing of the market. Whether that's going to reflect on downturn in prices, I think it's going to be swayed a lot by volumes and desperations. But we don't see a huge amount of people having to panic sell because we still have a sub 25% LVR right across the country, across every asset. And we have to remember that is that the vast majority of owner-occupiers and investors are in a very, very strong space. So liquidity is still there. People don't need to panic sell, even if they're in a position where they might not have an income for a period of time, because we've got banks pausing potentially mortgage rates. We're going to have a package that's going to assist renters, which is also then going to allow landlords to not have to panic sell if they don't have an income on a property. And remembering that investments or investment properties are probably one of those very unique asset classes which allow people to actually insure their income for loss of rent extra. Now, depending on your insurance policy, you can insure that loss of rent for anywhere between 2 weeks to 16 weeks in some cases. So people can actually insure their income in those investment properties if they lose rent or rent stops. So they're going to have a lot of different levers to pull to be able to hold in these times. But I think there's going to be opportunity in the next 3 to 6 months unequivocally. Time now, if you're assured in your job, you've got your buffers and pre-approval in place. The one thing that I think I am certain of is there's going to be opportunity.
Landlords forced to provide free rent for a period of 6 months. I cannot afford such a thing. I'm not Centrelink, but an individual who has lost income as well. What do you do?
Well, I think this is I think ultimately that's never going to happen. There's absolutely no way that the banks nor the individual state-based institutions, which are representing both landlords as well as the tenants, are going to say that the solution is that landlords cover the rent for a period of time, because ultimately that's just not going to be feasible. What is going to happen is you're going to see people for the short term who will be out of employment and are renting and can't make ends meet from a rental perspective. But we're going to see two things, one of which is a package that's going to no doubt going to assist both renters for rental assistance for a period of time. We've seen a doubling of New Start allowance from $550 to $1,100 or $1,200, or $1,100 rather, per fortnight. So we're actually seeing an immediate injection of people who are out of an income. So that will assist a lot of people in a lot of different markets straight away. And we're also going to see that the banks have already come out with 6-month mortgage holidays. And because that's going to be, most of those loan terms are over 20, 25, 30 years, they're happy to take on those 6 months of mortgage repayment holidays. And that's going to be of great assistance to any landlords who are sitting there saying, I don't have an income. The banks have already come out. They've been the first ones, as much as you and I are probably first on the front foot to say that they're typically not the ones who are our best friends and are making life easy for us, because they're always worried about number one, which is true. But because we've got such a robust banking sector, they're in a position where they can offer that. Now, yes, their share prices are going to take a hit for the short term, because they're going to have to make sure that they don't want to see their landlords default or their owner occupiers default, because they don't want a whole host of properties on their books that they have to sell at a short. So they want us to keep landlords in their properties, which this 6-month mortgage repayment holiday, which will come in lieu of people not being able to make their rent, will be another factor of assistance, in addition to what we already talked about, which is insurance in some cases. And I'd encourage any investors out there to make sure they get in touch with their insurers to make sure they understand what their cover looks like for loss of rent extra. But that's the other lever that they've got to pull there, where they actually have, for a relatively small amount that they'll have to pay to actually access their insurance policy, they've got between 2 weeks and 16 weeks of rental coverage.
Now, I think, Paul, it'd be a good opportunity for us to have a look at some of these bigger macroeconomic factors. So obviously there's a lot of decision making taking place in a fluid environment right now around COVID-19, and that's fair enough, but long-term prospects for Australia still looks pretty bright. The Prime Minister, our leaders are talking about 6 months now where we're going to have a disruption to the marketplace, and hopefully in 6 months' time, or it might be longer, when we can start thinking about being positive rather than negative. Now, there's a question here from Kevin. So Kevin, thanks for writing in. Kevin says, will the property market become like the US in the GFC? Can we expect a 200K drop in the Sydney market? So these are the sort of questions that are coming through. What we need to remember that this is a health crisis, whereas the GFC was very much generated from a financial crisis. But Paul, you tune into, you're a fan of Bernard Salt. We had him present right across the nation about a month ago, Sydney, Brisbane, Melbourne, Perth and Adelaide, for one of our big mortgage summits, talking about prospects for the economy, prospects for Australia. And it's very positive, isn't it? The long-term economic growth and opportunities for the nation when it comes to ongoing property development, the need for property, the need for housing, need for shelter, and the evolving way in which we live. It's still looking very positive, isn't it?
Unequivocally. And I think one thing that's I'd want to reinforce for our webcast today is the fact that this is not a statewide or an Australia-wide crisis. This is a global health crisis. So what that actually means is that for very much the one time in our history, our living history, is that everyone is actually going through exactly the same thing at exactly the same time, where the GFC or a lot of the other stock market crashes and downturns over the last 5, 10, 15, 50, 100 years have been based on one economy, then potentially filtering into the next, then the next, then the next. But we are all going through this ultimately within the same time, and we'll come out of it, no doubt, in a relatively similar time. The one thing that Australia is probably better positioned on now than almost any country in the world is how we then capitalise on the back of this. Because what's going to happen is everyone's economy is going to take a hit, but everyone's economy is going to rebound. But what happens is those economies who are in best position for healthcare, for education, for resources, exports, for everything else that they've got as a healthcare sector from education that we already have, that's part of our reciprocating rights as Australians, is going to become more attractive to everyone overseas. And to your point of what Bernard Salt does really well, he paints a very, very clear picture, and that picture can turn then into translate into what it means for the market. And I know we've discussed that Australia at the moment sees about 370,000 people coming into this market from a births, deaths and migration. We migrate somewhere between 210 and 230,000 people per year in Australia. And then we've got another 130 to 150,000 births or deaths, natural growth within that market. Then we look at what we've already got. So where were we a month ago? Well, we needed 180,000 dwellings constructed per year, every year, to keep up with the current demand. And on the current trajectory, we're building about 130,000. So we're already in a deficit of close to 50,000. And if this downturn does play out for another 6, 12, 18 months in the construction sector, we're probably going to be more like in need of somewhere between 60 and 70,000 additional dwellings per year, which puts us straight away into a very, very undersupplied market across the board. So where the demand's going to lie in the next 6, 12 months looks very, very attractive.
Macro conditions, Paul, look okay. And back to our question around where the property is going to drop $200,000. What do we wait and see, or you think that's not going to happen?
My biggest position here is trying to predict whether a market grows by 5,000 or if it retracts by 200,000. We're in a position right now where, regardless, to hold an asset in Australia is going to be the absolute most affordable it has ever been for a minimum of the next 2, 3, 4, 5 years. So if you're thinking about what happens in the short term, similar to anyone who's looking at any investments over a long-term period, the short term really is for me quite immaterial outside of the fact is, can you afford to hold it? So my biggest concern and consideration right now is because of where Australia is positioned for the next 5, 10 and 15 years and beyond, right across the board is I'm looking at what does it cost to hold an asset in the next 2, 3, 4 years. And it was literally, based on the numbers we've already gone through, it is going to be the cheapest and most affordable time to ever afford, as well as pay off assets. So the time to actually create that generational wealth and access these properties, if they are at a discount, then I'll be buying more. If they're not at a discount and they hold true and they flatten out for another 3, 4, 5 years, then you're holding assets and they're cash flow neutral at a P&I repayment position. So for me, looking at it, are we going to enter into a 10, 20, 30% discounting of property? I doubt it's going to go to that higher end, more so because of where we see the undersupply and where the economy is positioned longer term. But I think ultimately, I'm looking at my own portfolio to say, what do my cash flow positions look like? And I know full well that my cash flow has never been better. Regardless of whether I see rental arrears or not, I'm going to see that my cash flow right now is the best it's ever been. And if anything, it's probably going to get better in the next couple of months due to the last 2 interest rate cuts as well. And I'm assuming your portfolio will be very similar, Taryn.
How you can capitalise in this particular market. So your recommendation, Paul, is that speak to your broker, make sure you got the best rate?
Absolutely. I think get your broker sorted out for your best rates, and probably don't, again, I think the biggest thing is, again, there's going to be some very attractive fixed rates. I'm still a big fan of saying, make sure that you're holding variable rates right now, because this will consistently be a changing market. Please don't fix yourself in, is my personal, without obviously knowing your specific advice, depending on where it and how it sits. But my personal position is I'm keeping variable because I don't necessarily know where the next opportunity is going to lie. Now, that's both on what I might buy next, but also what I might sell or what I might want to pay down or what I might want to change over to a different bank who's offering a sharper rate, because there are bargains going left, right and centre, both in the acquisitions as well as the mortgage repayment space. So I'm going through a huge refinance in my portfolio right now because the opportunities that sit there to better my cash flows are most certainly sitting there. But I think the things to do to get prepared is make sure that if your jobs or your incomes are somewhat assured, your buffers are in place and what that you deem to be comfortable with what you can operate on for the next 3, 6, 12 months and beyond, as well as whatever asset you're going to buy fits into those buffers that you need, so they're not going to be too cash flow negative to impact your own personal day-to-day cost of or process or cost of living or the way that you actually live your life. They're the things that if you can tick those 3 boxes, I think you're going to be in a better position now than probably you've ever been in your life to actually maximise what you can do from a property perspective if you're looking at a 5, 10, 15-year horizon.
David writes here, it's now about access to finance. AAA borrowers in a new environment will have access to great property acquisition opportunities in a couple of months. This is about being prepared. It's about getting your stuff ready right now.
Yeah, I think David's hit the nail on the head there. If you haven't already spoken to your broker, or if you are in conversation with your broker, what I'd be doing is making sure whatever you're planning to borrow, get your maximum approval amounts understood, get your buffers understood, as I'll just keep harping on about the same things. But once you're there, get ready, get poised, and understand which markets are probably going to, and I think we've already touched on which markets and probably the major metro markets that are going to see the huge rebound and the huge influx of additional jobs creation on the back of where the stimulus is going to have to be injected. And they're going to be looking at how do we funnel jobs into the biggest markets, which is Sydney, Melbourne, Brisbane and Perth to kick it off, and then there's going to be filtered out markets from there. But they're going to be the main priority markets for everyone in the federal and state parliaments right now to say, how do we make sure that we're both assuring jobs and creating new jobs over the next 3 to 6 months, as well as then looking at the 2 to 5 year proposition.
And Dave writes here, the bank's deferral of loan repayments for 6 months, is this applicable to investment loans or home loans? Dave, I'm not absolutely sure on the specifics, Paul. I don't know if you can fill us in, but we'll make sure we get that answered for you. Have you got any information on that at all, Paul?
Look, we did read through all the Big Four's policies on this, on the bank holiday or the loan repayment holidays only yesterday. To be honest with you, their terms and conditions are quite long and they're all a little bit different. But there are some pretty standard Q&As that they've already provided. So if you are wanting to go down that pathway and understand if it applies to owner-occ or investment loans, in short, yes, it does apply to both, but it obviously has to then qualify via their criteria. So each one of the Big Four have pretty much prioritised this on an of their websites, so you can actually go and read the Q&A as well as what the qualification criteria are going to be. So jump on any of their websites and you'll be able to find that information.
Nice one, Paul. There's a couple of questions here. Future of house prices in western suburbs of Melbourne. That's from Anonymous. And there's another question here in regards to I want to buy a lot, like a lot of land in western suburbs, Rockbank, Deanside. What's your opinion on this?
Yeah, look, I mean, I think it's relatively similar place to where we see the Sydney western suburbs, southwestern suburbs of Sydney, where the big priority growth areas are going to sit there from an infrastructure perspective, as well as if they're looking at parts of the Brisbane market, we've got some big priority infrastructure areas towards the north and towards the west, towards the Ipswich corridor, the Moreton Bay region as well. We're going to see that's where you've got the bulk of population, you've got the bulk of infrastructure and jobs that are going to be then piled in. So yes, there's going to be short-term insecurity and job uncertainties in each of those markets, just like there is everywhere. But I think if we're looking at where they're going to be positioned longer term, we're going to see that each one of those markets are going to be priority areas for jobs creation and priority areas to be able to support people who are also in the tenancy position. So each of those markets, I think what we'll probably see is a little bit of softness as far as supply in those markets for a 3, 6, 12-month period. But one thing that this will also do is that if we don't see people transact and we're still seeing immigration or natural growth of our market, is it's going to be putting more demand on existing rental property, because we're going to see less supply in the short term. We're going to see less people buying their own homes, so putting more demand on existing rental stock. Now, it might not mean that we're going to see rent increases, but it probably will mean that we're going to see some big bottoming out of actual vacancy rates, because demand for existing rentals over the next 3, 6, 12 months, if people aren't going to buy that home and we're planning on moving out of house, then they might then go say, well, I'm going to rent instead of buy because I might not be able to get my loan that I'm after, or I might have a bit of job insecurity. So that's something that we expect we'll see more demand, is that rental space in those areas which are already currently undersupplied.
Should you be basing your investment decisions right now, Paul, on whether or not you're going to have a tenant, considering the market in flux? Is that a key priority, do you believe?
Not at all. I mean, that's probably one of my least concerns. Personally speaking, I'll revert back to my portfolio with a lot of properties in it and a lot of different tenants in a lot of different marketplaces. And I've got personally investments that are probably as low as sub $200,000 in my portfolio to properties which are north of $3 million in the portfolio. And ultimately, I'm not looking at which ones are going to be more at risk of tenants defaulting. It's probably more so aligned to which markets are going to see A, the supply issues, B, which ones are in areas which are going to be impacted more by jobs. But also, I mean, the irony of this scenario too, with the doubling of the New Start allowance and support for those who are unemployed and also rental assistance, is that those who are potentially either A, employed by the government, or B, are on some sort of assistance, they're the ones who actually are going to have pretty much an assurity of their income. Now, if you're in areas which are lower socioeconomic right now, the irony is that you've probably got tenants who potentially are already recipients of some sort of government assistance. So the chances of them defaulting on their rent is going to actually be lower, because they're seeing a doubling of their New Start allowances and a lot of their provisions there. So some advice I would probably put out there is that if you do have potentially a government-assisted, financially government-assisted tenant, get in touch with your property manager as well, because there is opportunities then for them to get onto what's deemed to be centre pay, which some are applicable to get onto that. And what that means is that Centrelink actually pay the landlord before they pay the tenant their weekly, monthly, fortnightly injections of cash as well. So there's an opportunity there to make sure you actually assure your income, because you can get paid directly through the government. It does cost a little bit of rigmarole, but personally speaking, I've got quite a number of properties which have tenants who are Centrelink recipients, and I do get them through Centrepay. So I know that my rent comes in, they get their money, everyone's assured, there's no defaults.
Are there any implications on investing in property through an SMSF with the proposed release of super for people who need it? This is quite specific. So what we're referring to here is that people being able to draw down on their super and how that might shape the way you can lend moving forward. Paul, your view, is this definitely an accounting question?
Look, definitely nothing we're going to say here is advice on that. I can only say what I know and potentially how it might impact me. But ultimately, what we know is the fact that we can access potentially $10,000 tax-free of our super for this financial year and $10,000 tax-free for our super for next financial year. And that can come straight to our bank account on an individual basis. Now, how you qualify for that, I'm not going to give that information because I don't technically know the exact ins and outs of how you qualify. But what I do know is that is accessible for some. Now, what that's going to mean for a self-managed super investment, that's your choice. If you've already got the funds in there and you choose to take it out, then quite clearly you're going to have less funds in your super balance to actually be able to utilize it. I don't necessarily see that this is actually going to have any adverse impact on the SMSF property investment space. If anything, what it probably does is anyone investing in SMSFs from a property perspective, typically I'm a big fan to say you need a minimum 10 years for that investment in SMSF to do its work. So I look at this to say if you are thinking about investing, or if you've got an SMSF that you've had set up and haven't bought a property recently, you're probably one of those rare people who have done very well out of this situation by doing nothing, because what you've done is you've set up your SMSF, and I've got a number of clients who are in this position. They've transitioned all their cash over and it's sitting there in cash, not in the market. And they've sat there over the last 3 months and watched their money that they thought they could have made, which is now diminished by, in some cases, upwards of 30, 40, 50%. And who knows where the bottom of the equities market's going to be found. But they're in a position now where they've still got the same amount of money. They've got probably slightly better borrowing capacity because their interest rates are going to be lower in their SMSF borrowing, and the opportunities for that property to buy at a good price, as well as then be able to afford to hold over the long term at a higher cash flow position, is probably better than what it was 3 months ago. So SMSF investments, if you've got 10, 15 years and beyond for that property to mature, I look at it saying this is a really good opportunity time.
Yeah, this is a very important question to have with your accountant, a discussion to have with your accountant around the immediacy of potentially cashing in some of your investment to see you through this period of time versus the missed opportunity moving forward. What's your thoughts on purchasing house and land, townhouse unit properties that will not be ready to settle on in 6 months plus time frame? So this is really going to buying off the plan in this current market. Maybe there's some big bargains out there as developers try and shift some stock to get some pre-sales on it. Settlement not be for 6 or 12 months in the future. Same things applies in terms of buying off the plan. Do it with a lot of guidance and knowing what you're trying to achieve.
Yeah, I couldn't think of and I'll say this with the preemptive comment that I'm rubbing against the grain for a lot of viewers, no doubt, and I apologise if I'm going to rub people up the wrong way by saying this, but I couldn't think of a worse time to be buying off the plan. Full stop, we don't buy off the plan, but ultimately in an environment where in all likelihood we're definitely not going to see valuations, I think, on anything off the plan increase over the next 6 months when we come to the point of settlement. I think anyone who's thinking about putting a deposit down on something that's going to be completed in 6, 12, 18, 24 months, right now is going to be a high risk and potentially low return type of proposition. We're going to go into an environment where you're going to see lower valuations on these newer and off the plan properties. We're already seeing them, and they've been happening left, right and centre for the last 5 years. I personally would say that if you're thinking about committing to that, pause, think about the established market. And if you are already committed to it, just please make sure that you get in touch with your broker, your accountant, your financial planner, as well as any agents in that market which you're going to settle in, to try and get proactive in getting tenants in place well beforehand. And really, valuations are going to be the biggest risk for anyone who's looking to settle on these new and off the plans. And if you've got a short valuation scenario and you've got less income, then that's where you see people put themselves in a precarious position unnecessarily.
Thoughts on buying a display home with a lease back for a couple of years? Again, it's a little bit of a different scenario than a traditional just purchase a property and rent it out. Thoughts on that sort of thing?
Yeah, look, I mean, ultimately it's a commercial lease scenario, and that's what we look at here, is that if we're going down the pathway of commercial investments, if you're looking at something with a 2 to 3 year lease back at a net return, less expenses, and we've looked at plenty of them over the years, and yeah, sure, they look attractive on paper, and let's say hypothetically you buy a $500,000 display home and they're offering you 7% net on that property, then that's going to be 35 grand a year income, less a 3.5% interest only repayment on that same purchase. We're talking, somewhere around about, let's say $10,000, $15,000 a year net income from that property. Sounds great on paper, but what is happening right now, and if you're investing anywhere commercially, you really need to consider the viability of that business, because most of the time these properties are going to be, if you transact and you own it, then look, most of the time at best you're going to see around about a 3-month bank guarantee on that tenant. But if the tenant goes out of business, they can just say, look, we'll say goodbye to 3 months worth of cash and we'll just give you that, and you can then be left with a property that, typically, in all honesty, a lot of the lease back for display homes are way overpriced to start with, and then you'll see you're owning a property which will rent for a fraction of what you've got that guaranteed lease for, and then long term also are probably going to be seeing shorter valuations because you've overpaid for a overspec property in an area which doesn't really have the demand for that type of asset either. So I'd always do the same fundamentals as saying, what are you buying as a property? What are the comparable sales for that property in that area for what you're buying? And are you buying a good value? Take off the table the cash flow for the short term because it is always short term. Think about what you're going to do with that property over the next 5, 10, 15 years. You might see an opportunity from a $5,000 a year, $10,000 a year additional cash flow, but that's very short-lived. And anyone buying residential investments, 95% of those people are going to be making money out of capital growth over the long term. The cash flow keeps you in the game. It's never going to be what you're going to get out of that property in the short term until you've paid off that debt.
I need to sell my family property on New South Wales mid-north coast. Given the situation, should I just hold until this is over or try and sell ASAP? This is, there's a whole bunch of moving parts with that, isn't it, Paul?
Absolutely, and I think you're going to see that question's already been asked to me by numerous people who are thinking about selling their property, and they were already gearing up only a month ago saying, we're planning on selling our property in Q2. The biggest thing I look at here is that if you're in a position and you want to sell or have to sell a property, there's a big difference between have to sell and want to or need to sell. And for me, if you're trading in a market, that's the same market. Whatever you get for that property, if you're buying and selling in that market, ultimately it's the same as it always has been. Whatever you get, you're probably going to buy for. So I would always consider, say, if you're selling for the sake of selling and you're going to buy back in that same market, similar price points, etc., upgrade or downgrade, the market's the same if you're doing it within a 2-3 month period. You're not going to really see much variation. However, if this is a property that has cash flow that you're looking at saying, look, it doesn't actually necessarily need to be sold now, we can wait 12, 24, 36 months, then I'd say don't force the hand unless it really, really needs to. And if anything, if you're looking at saying, look, we can probably afford to hold it a bit longer, then get in touch with either your buyer's agent to talk through the strategy, talk to your broker to talk through the cash flow scenarios. Can you refinance it differently that's going to lower your repayments and allow you to hold it a lot more cost effectively for the short term or medium term?
Off-market buys in this particular environment, Paul, is this something that you find interesting, attractive? Are you getting many calls from real estate agents under the COVID-19 situation to try and get more properties sold before taking it to auction or taking it to market or marketing it at all?
Yeah, look, absolutely. The irony of this scenario that we're in right now is, as a business, as pure property investments, we probably buy about 95% and have for the last 4 or 5 years bought about 95% of our assets off market anyway. And also that means for our clients is that their process or their experience of buying a property with us has always been similar to where we are forced into now, which is our team arrange current photos, video walkthroughs of the property and do full feasibilities on easement checks, flood checks, overlays, comparable analysis as far as what's sold recently, what's on the market, what's renting, the demographic breakdowns of these properties. Everything that we do is actually now being forced for everyone else to do, but above all, off market has always been our flavour, and we know that minimising competition means that we're getting the absolute best price possible. We're definitely getting more phone calls, but the process of those phone calls is exactly the same for us. So we're in a really good position to be able to get our clients the best possible scenario because the phone calls come thicker and faster of off-market opportunities. We're very well versed on what properties are what worth what and what we've been working on for some time. There's a lot of properties that we're getting calls on now, which we've been working on for 3-6 months, which haven't come to fruition because we've been in a growing market. Now we're seeing the tables turned, and now we come probably to a little bit more of a power position, which obviously is a good scenario for us to say, we want it for this client, but we're going to be prepared to pay X amount. So that's the part which I think everyone needs to be aware of is don't jump onto an off-market property first and foremost just because it's off-market, because on-market or off-market, the same process needs to apply. Do your comparables, understand the cash flow, understand what the quality and condition of that property is, and does it actually fit both value proposition as well as what you need for your portfolio at that time.
And for a lot of people who are looking to capitalise in this current market, and there will be opportunities for those that know how to find them, and I agree with you, Paul, just because something's off market doesn't mean it's good value. So the intrinsic value of that property needs to stack up if you even proceed down that basis. But you talk about cash flow. So we move into an environment where it's going to be cheaper to hold property purely because interest rates are lower. So let's have a discussion around what's going on with the banks. And Adam writes in here, will the banks still have the appetite for new lending, refinancing, investment lending during this time? Banks like to lend money, don't they, Paul, to people that they know can pay it back?
Mate, there's never been probably a more compelling time for banks to want to lend money for people who they know can pay it back. And if you can assess your situation to say that your job's secured, your buffer's there, your income's there, and your borrowing capacity's there, banks are going to look at you the same way. And if anything, they're going to be probably becoming a little bit more loose around their lending standards if they can find the right lender, or the right borrower rather, who's going to be in a position where they know they can make the repayments over a long period of time and they're in a position to get things moving. It hasn't changed. From what we can see, fundamentally, nothing's changed. If anything, the things have gotten probably more attractive. The fact that money's gotten cheaper and will remain cheaper for a longer period of time. But fundamentally, banks are going to assess it the same way, and they're going to have more pressure from APRA as well as the RBA and the government to say we need to make sure that money's been injected into the economy to allow us to continue to live the lives that we've been accustomed to living as Australians.
Should you be basing your cash flow on where we are right now, or should you be putting some fat in there as well? Should the market change and you start seeing interest rates going up, whether or not that's going to happen at any point soon, who knows? But you should be planning for that future.
Yeah, absolutely. Look, I think nothing's changed as far as where anyone should be considering and the way I sleep at night personally. I mean, I couldn't be more comfortable with the properties that we've bought in the past and the properties that we're going to consider buying in the future. Nothing really fundamentally has changed. If anything, I'm probably more confident in the fact that people are going to be in a stronger position from an economic cash flow perspective for investments. The market unequivocally is different, and it is going to become different ongoing. I think things are going to actually systemically become different permanently, and I think this is going to expedite the speed of transaction of properties as well as the ability for people to transact remotely, which over the long term is actually going to improve the whole real estate market from a trade and in and out liquidity perspective, which is going to help everyone. That's going to be something that's a fallout of this regardless of whether people wanted it or not. We're talking about digital settlements, we're talking about documents being signed by DocuSign for things such as mortgage documents, etc. We've been digital as a business since we started anyway, so nothing's changed there. But I think people do need to know that things are different. What isn't different is that you should always assess your position, your ability to buy property based on your current position. And that's job security, that's income, that's buffers, and that's borrowing capacity. And then look at these properties that if you do see that, yes, I'm buying at a 3% interest rate, chuck on an extra 1%, 2%, 3%. But ultimately, that's what the banks are doing still. The banks are still testing everyone's ability to repay at about 5.5%. So be confident in the fact that if you're able to access funding, your serviceability has been stress tested against about a 5.5% interest rate anyway. So the buffer's already been put in place a lot of the time by the banks. And that's why we have one of the best banking systems in the world, is because we are assured. We do put the stress test before I go and lend someone money. We test them against that 2% increase on where you're at. And that has been happening forever and a day.
We've got to remember, if you look back to the GFC, and some of the questions earlier was around whether or not we're going to see these rapid price drops like we saw the GFC in America. The GFC was a financial issue. This is a health issue, and obviously it's going to have an economic impact. But I look back to the GFC, and it was in our younger days when we were only kicking off with our media organisation. It was tough times, but Australia was relatively unscathed, or come out of that relatively unscathed, already poised to grow after it because of the strength of our banking system, the prudential strength of our banking system. So in many ways, I feel as though our lenders are going to be supportive during this period of time, and lenders will want to lend. So just make sure you put the best package in front of them, the best proposition in front of them to give them a reason to lend you money. Because if you're those people who you can afford a mortgage, you can service the mortgage, you can keep your cash flow prospects good, there is opportunities coming down this market. So this Smart Property Investment Live, Paul, COVID-19 and the impact on property investing in Australia. We spoke about the impact, if any, the virus has had on the market so far. Our position on that, it's a work in motion. Keep informed, keep it educated, because, Paul, things change by the hour, if not the minute at the moment.
Yeah, absolutely. And I think, Phil, to your team's credit and yourself, is that providing regular updates here couldn't be more important. And I think we've never seen such a fluid environment from an economic or health perspective. So what we're going to see is a round 3 of stimulus, no doubt, come out sometime very, very soon. So that's going to have some sort of impact on the market in general as well. We're going to see some changes to what it's going to mean for rental assistance. There's been no real detail around that yet. That'll happen in the next week or so as well. But I think ultimately it's going to be a very, very important time to get in touch with your A team team, your broker, your buyer's agent, your accountant, potentially a financial planner, and make sure you're subscribing to information that's going to be trusted and that's not going to be opinion-based. It's going to be fact-based. And Smart Property Investment as a website and as a business always provides very, very accurate data and very good insight. So I'd say and recommend to anyone continue to tune in, get the daily newsletters, and look at where those podcasts are going to take you over the next few weeks and months, because there's going to be some cracking information and ultimately cracking opportunities for anyone who's prepared and willing to take that next step.
What COVID-19 is going to mean to existing investment property owners. We touched on some of that around whether or not your renters, your tenants are going to continue to provide you rent, but also how you can navigate your way through the market. Your summary of all that?
Look, I think it's business as usual. Until the data says otherwise, nothing's changed. I mean, this again is a global crisis that's going to impact everyone and anyone relatively similarly. What we also got is we've got the nation, we've got the states all coming together to provide some stimulus as well as backstops for anyone who is potentially suffering from hard times. So the ability for people to be able to protect their income hasn't been better. And I think that's the beauty about property in general, is you've got insurance, you've now got a stimulus that potentially is going to allow for rents or renters to have some sort of fundamental backstop if they do fall short of rents over the long term. And we've got banks come to the table with up to a 6-month mortgage holiday as well. So we've got 3 facets which have never ever been offered out there. So the assurity of people to be able to hold their assets over the long term, especially through the short-term speed bump, which it most likely will be when we reflect back in the next few years, has never been better.
Yeah, and if I was you as a property investor, as I am, cash flow forecasting right now, look where the gaps are, see if you've got capacity potentially to start lending again, and whether you might be able to balance out your portfolio over some different assets, maybe a cash flow asset, or maybe even a capital growth asset to capitalise on those cash flow situations. Everyone's cash flow is different, Paul, so you need to make sure you do those sums by yourself. Another point here we wanted to cover was where the opportunities are going to be and how investors can take advantage. And this is about being prepared, isn't it?
Absolutely. I think first and foremost, be prepared, be ready to strike. Without being prepared, I wouldn't want to see anyone make decisions on what they think or they think they should or shouldn't buy. Get an understanding of where your borrowing capacity sits here and now. Get an understanding of where your buffers are in place and your cash flow position is, because that then allows you to say, do I target a growth asset, a cash flow asset, or even potentially a future development asset? There's going to be so many different properties which are going to come to the table for anyone who's in a position ready to strike. And that's what we're doing day in, day out, is gearing up to make sure our clients are in the best position to take that action, because that action is going to reflect on huge returns over the next 5 to 10 years. But be prepared, get your cash flow and your borrowing capacities in place first and foremost.
And we touched on this, running off some of the demographer Bernard Salt's information, who's well regarded for his view of the world and Australia's place in the world, how the property landscape is shaping up for 2020 and beyond. Fundamentals, by and large, are still there, aren't they?
Yeah, look, I'm very personally quietly confident in what's going to fall out of this is the fact that Australia is going to end up reflecting as a much better positioned country than the rest to say, well, where people are going to want to end up being. And in times of economic hardship, you see people flood to where quality assurance, job security, as well as healthcare is at its best. And as much as we do like to complain a little bit in Australia about the state of play from time to time, we are far better positioned than almost any other country over the long term. So I expect that our demand for what we offer as a country in general is only going to increase once we see the bottom of this come through.
And our final point here, Paul, was the impact of an investor's 2020 property purchase will have a long-term investment goal. So the decisions you make now can potentially set you up for the decade ahead.
Absolutely, and I think that there's some of the conversations I've had over the last week with some investors who are probably in a relatively early stage of their investment journey, and they're probably the ones who I couldn't think of anyone who's better positioned. I think it was one of your first questions today, Phil, was someone saying that they've got their jobs are secured, they were looking to invest in September, they've got their finances ready. My position is that if you're in that scenario and you're prepared to look at a 5, 10, 15-year horizon of what you're going to invest in, you are probably in one of the best positions from an investment perspective than we've ever seen in our lifetime. So I expect that we're in that scenario right now.
So it's business as usual for you guys? You're open for business? If anyone wants to chat with you, they can give you a call, or what do they do if they want to reach out?
Look, where we sit right now is absolutely business as usual, and I'm having more important discussions now than I think we've ever had with our clients. So if anyone does want to get in touch, I think the key here is understanding the specific individual impact of what's happening on your objectives as well as your portfolio. So jump on to purepropertyinvestment.com, hit the inquire now, and you can schedule some time with me directly in my calendar. I think I've got a bunch of openings for next week and the weeks after that as well. Jump onto the website, they can order a copy. We're actually offering a free plus shipping option of my best-selling book now.
Is it a bestseller? Is it?
So it's a bestseller. It's also the winner of the Australian Property Finance Book of the Year, which was only awarded about 2 months ago. Yep.
What happens is someone books in some time with you to have a chat about property. Like, how do you be prepared for that? And what do? You just chat for half an hour around what they're trying to achieve?
Yeah, look, we always like to, for that catch up is really to understand where we're at now. So that includes things like what's your current income, what's your current assets, debts, liabilities, as well as what are your personal objectives. Now that's from a financial perspective, as well as it might talk about how long you have left or what you want to spend time you want to spend in the workforce. So how long do we have for these properties to work for you? And ideally from that, we get a very clear understanding of them being able to set short-term, medium-term and long-term objectives. So that's what are we going to do in the next few months? What are we going to do in the next 2 to 8 years? And what are we going to do for the next 2 decades? And how does that then ideally get you in a position of where you want to get to? And ideally out of that, we've also then got a very clear game plan and then look at, do we want to start buying property now, or do we look at getting pre-approvals in place, etc., or do we look at continuing to save and build up your buffers before we pull the trigger?
Okay, that's good. So purepropertyinvestment.com, go and do that. That's where you can lock that in. If you struggle with that, you can get in contact with our team here. We're happy to introduce you to Paul, editor at smartpropertyinvestment.com.au.